About monthly financial reports best practices, and we've got an exciting panel. We've got Rob, Martha, and Kerry here with us today. And my name is Mark. I'm from Whisper ISP, and a short introduction on our speakers today. First up, we're going to have Rob Bresnahan. He began his public career in accounting in 2001, focusing mainly on the telecoms industry. He recently joined Fibersmith in 2019 as their CFO. He's also and leading their virtual CFO and financial consulting branch, continuing still in the telecoms industry. His experience includes financial reporting, performance audits, reviews, compilations, business income tax, preparation. I could read the rest, but it's kind of Z, all of the above. Rob has a BSc degree in accounting from the University of Wisconsin and is a CPA in Colorado and Wisconsin. Next up, we'll have Martha and Hazenga, I believe. I hope that I pronounced that correct, Martha. But Martha's the co-owner and COO of DC Access, and she's responsible for sales, marketing, customer service, and HR. DC Access began in 1999, and Martha joined in 2004, which was 1 year after DC Access started providing wireless internet. Prior to DC Access, Martha worked at MCI and several telecom software companies in software development, marketing, and sales. They're based in Washington, DC, and they're an urban wisp there, and have got approximately 1,500 customers. Then next up after that will be Kerry Conn. She's a CPA certificate holder since 1994. She's got a Bachelor of Business Administration in Economics and also a Bachelor of Accounting in Accounting. She's been the Chief Operating Officer and Chief Financial Officer for Atlink for 14 years. So kind of it works nicely. We've got Rob, CFO, Martha, COO, and Kerry bringing it up, CFO and COO. So Kerry's been 25 years working in internet service providers and started with dial-ups to DSL to fixed wireless. She's got experience in small growing WISPs and also large $2 billion commercial ISPs. So with that, I'm going to move over to Rob. And Rob, you're welcome to take it away.
Thanks, Mark, for the kind introduction. It's always good to be back in front of everybody. Unfortunately, we're not in Dallas, and we all kind of know that. Unfortunate circumstances. You can see if you watch any of the other financial presentations from here, the last one, you can actually see my garage. I've been banished to the garage to get away from my kids. So, but I'm Rob Bresnahan. If you've been to any of the financial panels in the past, you probably know me. You probably know who I am, or at least heard of me. But this is a really fun topic. It's a new one that we've done. We talked about doing something like this for years. We've done it in different versions, kind of KPIs and different billing practices, but kind of monthly financial reports, actually digging in with the CFOs, digging in with everybody. And me being a former auditor and now kind of doing CFO work for a bunch of different telcos, I'm starting to see the other side of things that I never really dug into. And Mark can relate to that, being on both sides of things. It's always fun to be able to see it and see what everybody else uses at the same time, because it gives you a lot of ideas. First disclaimer I am going to make is that there is no right or wrong way of financial reporting. There really isn't. Everybody has their own version of financials that they use and that they're comfortable with. And that's always a good thing. You have to have somewhere where you can start that you understand your financials, find somebody that can help you work through it, another WISP provider, someone in the industry, a financial consultant, your local CPA, whoever it is. Find that person to help understand that. I know that everybody on the panel would probably agree to that. Let's go to the next slide, Mark. So we're going to cover the three basic financial statements: balance sheet, income statement, statement of cash flows. That's the basic stuff we're going to talk about today, and everybody uses something different. We can go to the next slide. Now, everybody looks at different things monthly, and some look at different things quarterly and annually, and all around. But these are the three financial statements that I recommend everybody look at least on a quarterly basis, if not on a monthly. But it all depends on what you're looking for and what stage your company is at. Okay, and we'll get into that a little bit. So I'm going to touch on these and a few tips and tricks and give you kind of a base level financial to look at. So what is your balance sheet? Your balance sheet's a report of financial health at any given point in time. typically the last day of the income statement presented, which is the end of the month, end of the quarter, however you look at it. But it's a report of the financial health, because the balance sheet tells you, on the positive side, how much cash you have, how much accounts receivable you have, which is technically what's going to convert to cash, money that's going to come into the company, and a few other, and the value of your company and your infrastructure, all of those costs. So then we're going to talk let's talk a few balance sheet concepts. This is back to accounting 101, no matter where you're at, where you took some classes online or, in South Africa or that's the easiest way to think about it. And we don't have to dig into this a whole lot, but I just like to throw that out there. It's kind of the basic stuff. Now, liquidity is another concept we always need to look at, and that's the relationship between the assets owned and how quickly you can convert those to cash. So if you need cash, if you're running into some problems, you can convert your inventory to cash, or you could always sell your accounts receivable, or just how much cash you have. Leverage, relationship between assets and the debt on those assets. That's a really good concept. I've heard in the last year, I heard a lot about how somebody looks at their financials and they want to be able to see their assets separated on a separate line, so vehicles, and then have a vehicle loan line so they can always see that here's the relationship between those two different types. But that's how, and I've never heard of that before, and that's how it thinks about financials differently. Did I freeze up again?
You can proceed, Rob.
Okay,
Yep.
You got me again? Good. We can go ahead and flip the slide. There we go. Balance sheet on the asset side, what to focus on. This is just kind of what I recommend to people. Always watch your cash balances, accounts receivable, inventory, your plant and service, which is the cost of your network. Additions and retirements. We just did a great session on budgeting and forecasting. Time doesn't matter now that we're in cyberspace, but we did that, and we talked a lot about forecasting and looking at either high level forecasts or low level forecasts. Capital additions, looking at that. That's a CapEx budget. That's an easy way to really start the budgeting and forecasting process. But to track those things on a monthly basis, to really watch those, is a great thing. I'm going to say one thing from the presentations, the 3 presentations that we're doing in finance. The one common theme that did come up a lot was make sure that you are valuing your network and putting assets on your books, because that represents a sweat equity with your company, and it helps compare you to other companies. So you have the assets and the plant and service. Just go to the next slide. So kind of just basic balance sheet, usually 3 parts. On the side of the assets, we have our current assets. That's everything within 365 days can technically, will be converted to cash or converted or used within that. Technically, inventory, I've always debated with that. But technically, you could convert it to cash very shortly. Non-current assets, we don't have a whole lot of those in your typical, smaller WISPs. This is when you get a little bit bigger. These are from a larger company that I work with. They have a larger investment portfolio, a lot of other things going on. Then we also have the property, plant, and equipment, and they have, this was when they had a smaller operation in internet, but they were really getting into that with telephone, and they were using that telephone network to provide the internet service. So you can see, you can look at the changes, look at, comparative financial statements. That's always a good thing. We'll kind of get into that. I have a few slides on that later, but let's flip to the next slide. And then liabilities and equity. So the other side of things outside of the assets of what you physically own, this is what is due, what you are required to be paying out in the future. So what to focus on? Always look at accounts payable, accrued payroll, know what know what you owe at the end of every month. Always look at your debt, and I really recommend that people break your debt out into different types because they all have different characteristics. And watch those, your line of credit, capital leases, long-term bank debt. And then if you're a stock company, watch your dividends paid and outstanding. If anybody's really looking, for dividends, if that's one of your requirements that you have to follow, and follow those ratios and such. So let's go to the next slide. So it's kind of the same thing. But you flip it, same thing as assets, but flip it to this side. So you have all of your accounts payable that are due. This is everything that's due within 365 days, usually what you look at for current liabilities. So then we always separate our long-term debt out. You can break all of your different debt into categories. It doesn't have to look like this. This is a form of what I used to use for auditing and reporting to the FCC, kind of the standards that they use. So this is really heavy. This is kind of the highest level, of reporting on that end. But you do whatever you do, report it how you want and how you're bored. Always know your audience. That's what I tell people. If it's for you, if you're putting it together for your managers, for the owners, we'll see that there's probably multiple sets of things that are presented every month from each of these folks. Then you go to non-current liabilities, and then you always look at your equity after that. So let's flip to the next one. So income statement, profit and loss statement, everybody calls it something different, but this is the financial record of revenues, expenses, and profits over a period of time. What you've brought in and what you've spent over that period. It shows you how well the company manages, sells, controls costs, and makes a profit. I searched for a long time to try and find a good way of, explaining what an income statement is, not just from the bean counter mindset, but it's how well you're able to sell your services, control your costs, and make a profit on top of it. Okay, let's go to the next slide. So different categories, you can put these in however you want. You can put everything together however you think it would be, best suited. But always do operating revenues, operating expenses, and then operating income. This is all the basic operations of the company. Not outside of the ordinary. We're all internet companies, broadband, ISPs. So you don't want to have, if you own a coffee shop or a porta potty business, you don't want that going in your operations. You might want it on a separate company, but it's always interesting to see those when I was doing my days of auditing. And then you always do your income before taxes, look at your taxes separate, and then bottom line net income. And a lot of people just focus on net income. A lot of people love that, but I'm going to tell you this, from an auditor standpoint and from a consultant standpoint, and everybody else here is going to agree with me, net income includes a lot of stuff that's non-cash, so it doesn't really reflect operations of the company. It's more of a reporting requirement. So let's keep going. Okay, like I said, it's most important to many people. Different ways to look at it. Single period can be effective, but it's limiting. You can't really do a whole lot looking at one period. 2-year comparison is most effective, but I really like to look at multiple periods, multiple years, multiple months. Look at your trailing 12 month, trailing 24 month. That's always fun to look at and see where you've come. And in today's environment, really focus on your operations-based figures. Focus on what is going to make you go up or down. What is fluctuating your revenue, your cash, your expenses? Focus on that stuff. That's just my 2 cents. So one more. So on the revenue side, you don't have to do this. You saw from the financials I've done before, they're very summarized. But, look at your operating revenues. You can break them out by different, classes, so fiber, wireless, and VoIP. You can also break out your wireless by, business and residential. I remember working with, we tried to do a benchmarking study for the industry a few years back, and we were all going back and forth on how much detail do we need to provide. And, we got down to nitty gritty on everything, but we had 15 different types of wireless service. And then we had it broken out between business and residential. It's almost too much information to gather and to actually use. So there is a limit to how much detail you can get into. only put miscellaneous revenues in as needed, but focus on the operations side of things. That's what I like to do. Let's go to the next slide. Then expenses, pretty basic, operating expenses, labor, benefits, and overheads. And some people don't track that a whole lot. A lot of people track it very heavily. So figure out what you're looking for, what you're trying to prove, what you're trying to drill down to, and make sure that your financial statements are representing that. Depreciation, that's just a basic concept, but there's a lot of different things that go into that number and different methodologies to do it. It's a book number. We're spreading costs over periods, and it means something, but it also doesn't when it comes to cash flow. So that's something you pull out. In our business, property taxes, depending on if you're in fiber or towers, that's a big issue. So you might want to break that out. Make sure you're paying your property taxes or reporting them. And then non-recurring charges, kind of just different things. You always have these buckets of smaller items that aren't really worth digging into. So let's go to the next slide. And then the other income and expense is all other type things, but you want to look at interest expense, total paid by type of debt. We just talked about line of credit, capital leases, and long-term bank debt. You want to break that interest expense out to be able to really look at which one's more expensive or evaluate how you're using your borrowed funds. One more slide. Okay, so this is a big income statement. This is a very big functional type income statement. And this is just one way of looking at it, but you can see there's local service, network access, a lot of internet revenue. Then it breaks it down into different categories. This is a basic Part 32, big consolidated company. But then you can also look at the operating expenses. They're functional categories. So all of the labor is put into these categories to make each of them kind of function on their own. So customer operations is everything related to what it takes to keep your customers happy, and there's labor included in there for your CSRs. So corporate operations is just your basic how you get everything running, but plant-specific operations are related directly to maintenance and repairs of your tower infrastructure and your outside plant, your fiber, your cable, different things like that. And it doesn't matter what format you're in, just as long as you can explain them like I just did. Because I know that 90% of the people that see this income statement are going to wonder, what the heck, why am I doing it that way? It's very strange. But if I know it and I can explain it to anybody, then it's a great financial. So let's keep going. And the bean counter is almost done. So generally accepted accounting principles require accrual method of accounting. So that's accruing your accounts payable and your customer AR. But we also want to look at cash flow. That's an even more important thing to look at monthly. So if you look at income statement, balance sheet monthly or quarterly, that's fine. But you need to look at cash coming in and out the door, and not just looking at what the bank statement says or the bank balance is. We've gone through these, a lot of times, but there's statements of cash flows, and there's easy and simplified ways, and there's very heavy, complicated ways. Let's go to the next slide. So, this is just the basic categories, nothing too major. Operating activities. What I say is, when you look at your net income and you add back depreciation and you add back any kind of oddball deferred tax, things like that, most people don't have, but if you just take your net income plus your depreciation, that's technically represents, after you bill all your customers, bring all the cash in and pay all your normal bills, you pay your employees, your benefits, your attorneys, your accountants, your consultants. What do you have left to spend? That's your operating activities. What are you going to spend that money on then? What do you have available to spend for the next two categories, assets and collecting of any note receivables that you have, different things like that. So it makes it what you have available to increase your infrastructure, and also in financing activities, how much you have to pay back to your loans. So we'll flip another slide. So kind of the same thing, true cash available, plant and service, and then debt borrowings. So you're kind of looking for, the first one is the positives, and then where are you going to spend it? The negatives are investing activities and cash going out the door for debt. It's an easy, simplified way, but you can make it very complicated like this. This is one of the hardest things that I had training people in accounting, is how to do a cash flow the right way. And it doesn't make sense to 90% of the population, but we're required to do it in those aspects. So I don't even use this much detail when I do month-to-month reporting now, but I just thought I'd throw it in there for good reference. So with that being said, Mark, I think this is my last slide. So with that being said, I appreciate your time today. I know I did kind of high-level stuff, but you'll be able to get copies of this presentation and have this stuff in your arsenal to look at. And it's all about getting more exposure to more things to bring your financials and make them better. So with that, I'll turn it back over to Mark.
Yeah, thanks very much, Rob, and we appreciate your insights on all of that, and me also, the traditional kind of bean counter accountant, can relate to that. But now we're going to move on, and we welcome Martha, and she's going to tell us how she goes about what's the numbers that she likes to look at every week or month to manage their business. Over to you, Martha. Martha, you still with us?
Oh, I was talking away on mute. Sorry. Okay, so now you can hear me, I guess. Great. So as I was saying, Rob kind of went over an overview, and now we're going to dig a little bit deeper into what some of the ISPs look at. As Rob said, everyone looks at something different, and each of our reports are either called something different, but it might look like something you have. So don't worry too much about the names and about how it's structured, but more about what you're looking for. So next slide. Okay, so we follow a process called EOS, Entrepreneurial Operating System. So every week we have a weekly meeting for each of our teams, actually, but this is our executive weekly scorecard. And so myself and my partner meet, and we talk about the weekly scorecard and other things that are going on. And the gist of this is, if you're on an island and your business is running along, what are the top 5 to 10 things that you would need to know to say, hey, the business is going great, or boy, I got to get on that plane and get back to the office because this is not working out so well. So these are the things that we look at every week. The number, what we call premature disconnects, so somebody who didn't move, prospects in the service area, site surveys, successful installs, service calls or repairs, the number of calls over a 5-minute wait time, and that's just for our weekend support. We're kind of monitoring them. Accounts receivable over 60 days, and cash deposited for the week. And then we have a goal for each of those. And so we're really looking to be within that goal to know that this is, things are still moving along, or if something's not moving along the way we want it to, why is that not happening? And then we might talk about it a little bit more in depth. Next slide. So then monthly, not only do we, talk about the scorecard and other things, but as part of our weekly meeting on the last Wednesday of the month, we also talk about how many people canceled, and then this feeds into our growth report. So this is just canceled accounts by what their disconnect reason and the end date, so I'm getting the whole month. And so I pull that report, and then if you go to the next slide, Mark, it goes into this financial growth report. So this is where I'm going to put my canceled subs in. I'm going to get the number of total clients that I have, and the number of the monthly income, and then it's going to calculate my ARPU, how many net subs did I actually get, what my monthly churn, what's my goal, all my goals for this, and how am I doing. And so you can see on the right, this year, my ARPU's gone bonkers, but my goals are not so great as we would like them to be. So, so this happens every month, and then we use this data and quarterly and yearly to come up with not only like how are we doing, but what are we going to do for the next year and next quarter. Okay, Mark. And then monthly, we also look at our profit and loss. So we look at this once a month. Occasionally, I'll look at it other times. I've been looking at it a lot this week for all the grants and SBA loans and stuff that I'm supposed to be applying for. And so we like to look at a few months, even though that just November and December are not part of this year, a few months back, just so we can see kind of an overview of different comparison of the different months. And so this month we were looking at November through February so that we could look at February's numbers, kind of see how things are going. And this obviously isn't the whole thing, but you got a good overview from Rob about what we're actually looking at for that. And then I think that's the last slide, but maybe not. Nope, one more. Okay, so then this is something that we do yearly, and we kind of keep this up and maybe even 6 months to see like how many people should we be hiring based on what our monthly revenue is, what our subscriber base is. Kind of just helps us know, giving some assumptions of how many techs do we need, how many customer service people do we need, how many office people do we need, based on the number of subs we have. And those are all assumptions that we've made for ourselves and that hopefully everyone else is making for themselves as well. And I think then that is it. Is that the next slide is Carrie, right?
Yes, thanks very much, Martha. Appreciate it.
Okay.
And, thanks.
You're welcome.
Thanks to Martha for those insights. It's obviously interesting to see from kind of one of the shared owners of the company. What are some of the things that Martha looks at that are important to her to make sure the business is going like it should? Next up, we've got Kerry, and she's going to, I think, expand on that a little bit further. Thanks, Kerry.
Thanks, Mark. I appreciate the introduction. And most of my presentation is based a little bit more on what drives the output in the monthly financial from an operating perspective. So if, Mark, you want to go to the first slide. One of the things that we always track are the number of customers, but we also track the number of revenue generating units, because as you get larger, one of the things that you'll notice is as you install a business customer with 5 locations, some people will say that's 5 customers because it's 5 connections. We consider that 1 customer, which is a revenue generating unit. And then we can look at the ARPU for revenue generating units by industry, and it gives us a lot of insight into where we can get higher value customers. And as you'll see, in this kind of made up graph is how many services do each of those revenue generating units purchase. So what we look at is how many add-on services. Did they purchase, pay for a router? Do they pay for additional tech support? And so that we can maximize the number of services that we're providing to each of those customers. So this is typically the first thing that we look at, and we look at it at least every day. As we come into work, we have an email that goes out that just says, where are we every day and how are we doing? And you can go to the next slide. The next thing we look at is headcount, is how many people do we have in which department? And then we would typically add in, what changes that we had and why did we have them. It's typically as we add subscribers, obviously you have to add headcount, but it's a different decision when it is a fixed position that does not vary with the number of subscribers. In the call center, obviously that's going to go up just as subscribers do. So when you watch subscribers, you have a very good idea when you need to hire in the call center based on hold times and what you've historically seen. But in terms of hiring fixed employees, grow with subscribers like an accounts payable person, it's a lot easier to discuss it when you look at headcount instead of with trends. So you go to the next slide. And we've been, our WISP has been here for 14 years. So one of the things that we always do is look at year-over-year trends. from our perspective, we have a very seasonal business. And so what you'll see here are, this is our a sales trend. And what we track are when do we do marketing and what did it do to sales. This doesn't necessarily reflect how many customers we have, nor does it reflect how many installations that we do. This is every single person who called in and tried to buy internet service. And then we track it geographically so that we can see the effects of our marketing and see which is working best and which is cyclical. Like we almost always have a drop off in August or in July as people begin moving, and then it'll tick back up in August. So the next slide should be actual installs. So if you look at these two metrics independently, you can kind of see from the last slide to this slide, they don't reflect the same information. So depending on what areas we're in, how many trees, how many hills, what's the failure rate, these are very different slides. If you're running an operational group and you have to decide how many people to hire, it's different for inside sales than it is for installers in the field. So they don't necessarily trend exactly together between sales and installs. So the next slide, we look at disconnects year over year, and you can see I kind of manipulated the data so that it didn't reflect actuals. So you can see very clearly the trends. Like if you look at this giant peak in the middle of July, that typically for in our area would reflect disconnects due to storms. If we had towers destroyed by tornadoes that we couldn't get repaired for months, or in November, for some reason we just don't have very many disconnects in November. So it's important to look at it so you can kind of trend towards the future. On an operational side is how many techs do you need in the field to pull equipment? How much equipment are you going to recover from the field so that you don't have to buy it next month, which helps your cash flow? And then you're not quite as surprised when you finally see the income statement. If you've seen disconnects trending, if they're trending upwards for the last quarter, you can expect your quarterly income statement is not going to look as good as the previous quarter. So it translates from what your staff is accustomed to seeing into what you can expect to see on the income statement. So the next slide, we also track, very similar to Martha, disconnect types. We don't call them premature, but we do track how many are related to moving, how many went to a new ISP, and then we track it also by financial, which means we had to write it off for bad debt, pay their bill, which we typically combine with service issues. So in this example, we saw the peak in the chart, and then I highlighted 506 disconnects. It simply highlights somewhere that you need to go investigate. Should you see disconnects, double, especially if you're running a larger ISP, is the point at which you need to drill down more significantly with your service staff to analyze the disconnects. We can go to the next slide. We also calculate churn on a monthly basis, and then rather than looking at it year over year, we look at the effect over time so that we can look at that dotted trend line and see what's happening. And so at least in our network as a wireless ISP, it really swings dramatically. We might have double the disconnects in, say, August that we do in November. And so it's easy to use this graph to remind people what's coming up and what they can expect in terms of equipment showing up in the warehouse and jobs that have to be run in the field. And then, as I showed earlier, that giant peak, we actually, when we have areas where we're seeing a significant number of disconnects, which will typically be, a new competitor into the that has fiber to the home, we'll go into a specific market and look at how have disconnects trended over time so that we can predict when is the bleeding going to stop in terms of us losing customers to a new entrant, or it gives us, the ability to see if it's trending the other way the service is providing a value to the customers, and we don't, maybe this isn't somewhere we look to upgrade. So we can go to the next one. And again, we also track bad debt from disconnects when someone cancels their service without paying their final bill. And we look at it every month in terms of a graph of the percentage of billed to collected within the same month. And then we track it, every month to see how it's doing. This is one of, at least in our network, this is one of the key drivers to the income statement, which is the number of service calls per customers. We take the total number of truck rolls that our staff do to make repairs to customer installations, and we look at it over time. And we're in Oklahoma, we have lots of thunderstorms, so you can see these peaks when we have storms roll through, and then you can see, really big valleys. Some of these are exaggerated and some of these aren't. But if we have to go to 8% of our customers' homes that month, and we know that in week 1, we can predict what that's going to do to the income statement long before it has an impact on cash flow. So we plan this, and we plan our head count based on storm season. So if, we can see this is a very clear pattern that what happens every May and June. So we typically increase our resources in the field. We increase our on-hand inventory for things like surge arresters and radios that might get blown out in a storm. And we typically reduce our marketing expenses because we want to take care of our customers first before we take care of new customers. And so this is one of probably the single most important graph that we use to predict what the income statement is going to look like and what cash flow is going to look like next month. And then we also look at our field operations. And these are not jobs that have been run. These are jobs that we have scheduled in the future so that we can see, and I have to put my glasses on to actually read it, so that we can see how far out are we scheduled in the future. So we try to keep service calls out only 2 to 3 days, installs no more than a week. So we look at the field op schedule every week to see how far are we out in certain geographies so that we know whether we need to reposition field resources to different areas. And the next slide is, again, just a track of field operations. And you can see, again, some of these are exaggerated. When storms, you see the peak in service calls. Another thing we look at is other, which you can barely see on this graph, which is time spent by the field and tower crews doing things that are not customer related, and where they're not actually at a tower site or at a customer site. So this would be times when they were counting inventory or getting oil changed on their vehicle, or their vehicle was getting tires done and they waited for 3 hours. And so we always prefer to see this service call line down below installs. And so what we have to do is manage it more on an annual basis, because it always goes up during storms, and then installs will start creeping up again. So we can go to the next slide. And then again, we just look at total truck rolls, is how many employees do we have and how many jobs did we run that month, so that we can maintain our efficiency. We have certain standards per area based on the geography. If they're in a really big area, that has hundreds of miles, we might expect them to have 4 jobs. And if they're in an area where most of the customers are within 3 miles, they might be able to do 6 to 7 jobs a day. We try to manage it in total truck rolls divided by head count to keep the efficiency up, and it'll give us a real good indication when do we need to hire, oftentimes before we actually see it on the schedule. The next slide. And then this is something we always look at, that I included in here because it is kind of a KPI for us, is when we've selected an area that we're going to serve, and we decide we want to serve, Main Street in this town. What we also look at are the number of proximate, we call it a proximate market. So for those of us who are fixed wireless, it's basically a backhaul market. is if we're trying to get to Main Street and we need a backhaul tower 4 miles to the west, is to make sure that that is a good market for us to be in the future, should we like to put sectors on that tower. So when we put up a new site, we also like to look at the site that we targeted, as well as the proximate sites that we use to get to that market. And I think that might be the last slide. Oh, and then this just shows it a little bit better. We've had a lot of inquiries from banks and people who don't really understand what a backhaul market looks like. You can kind of see in the pink, we're a CAF recipient. So we have a census block group in the pink that we're required to serve for CAF. So what we did was located a backhaul tower where we have the most population of potential customers. And we used that to get to the customer or the census block group in pink. So we want to make sure that the markets that are proximate or adjacent to areas that we have a regulatory requirement to serve are also profitable markets, so it helps sustain those markets. And so we constantly reevaluate how many sales have we gotten in those areas so that we know if it's still a good use of funds for the backhaul tower and not just the endpoint. And I thought that was the end of my slides, but look, there's one more. Again, we look at on a project by project basis is what project that we done, have we done, how many households are in the area that we geocoded, what's our ARPU and what's our penetration. And I don't know if these are pretty close to actuals, but you can see based on, you know, what project we're on, the ARPU is remarkably different. We have one where it's $42 and one where it's $102. So it's really important that when you look at ARPU, you look at it based on geography. One, to see places where you might not be able to support in the future if you don't get your ARPU up or your customer count, or places where you might want to focus your marketing because the ARPU is so much higher than in other areas. Now I think I'm actually
Thanks
finished.
very much, Kerry. That was your last slide over there. So appreciate that. And yeah, thanks again to Rob and to Martha and to Kerry for that. I think it's been very interesting for me listening and observing. And I think as the listeners out there as well, or people viewing this, you can see there's a whole plethora of ways that you can get information, and different people use different information to give them the answers to the questions that they want to know about. So maybe one or two questions from my side is just quickly, there's a lot of information out there. Who does this need to be communicated to? Who are the users of this information? And is it the same information for everyone, or do you use different information for different people? Maybe just one or two comments on that.
Well, in our company,
go ahead, Kerry.
We use different information for different people. I think it's probably similar in other WISP. We don't have this long list of CPAs and financial people who can look at the statement of cash flows and the quick ratio. And it's a lot easier if you have a team that you can use more operational metrics that drive expense and revenue. And so we use different information for different people. The ones I've presented here are typically what we present to most of our senior management. And then the board and the executive team and the financial team look over balance sheet, statement of cash flows, and income statement.
And I would agree with Kerry that we're much smaller than Kerry. So Matt and I, who are the partners, are mostly looking at this data. But that weekly scorecard, we have one of those for each of our teams. And so each team, the tech team sees their own metrics, and the customer service team sees their own metrics. And then, we see metrics. And then when we do explain it to different people, if we're talking about income or how things are going in that kind of income sense with the entire team, we're going to use different metrics because everyone understands different things. And giving a income or a P&L, income statement or a P&L to our entire team, they'd be looking at it with googly eyes and not even really wondering, what are we looking at here? So definitely you have to give yourself, each of your teams different metrics to look at so that they're going to understand and help them understand how the company is doing.
All right, great. Thanks very much. And so maybe another question. I think Martha and Kerry, both of you were, and for any WISP, for us, for us included as well, we obviously keeping an eye on the customers that are canceling service with us. So this could be a tricky thing to track. Are they really telling you the truth? Do you know the real reason? And maybe the question is, any tips on there to get the best data possible? Because obviously, if we don't have good data, it's difficult to make good decisions based on that.
So one of the things that we do, the first question we ask is we kind of out of the box assume that they want to transfer their service and to find out if they're moving. And if they say they're interested, we can look and see if it's in our service area. And that gives us a pretty reliable indication that it's not service related. And then on all of the other metrics, we honestly just assume it was financial if they did, or service related. If they didn't pay their bill, it probably isn't because they didn't want to spend $50 on internet. It was they were unhappy with our service in some way.
Yeah, I would agree with that. We try to ask people if they want to transfer service when they're calling to cancel. And if they say no, that, we ask if they're having a service issue and try to, if they haven't, sometimes people will call before they've even been installed from another provider. And so we have a little bit of an in to say, can we come out and fix things and look at it? There might be some reason that they, the other thing we try to do is we call them proactives, but go to people's houses before they call us because they need a new router. So if you installed in 2014 and you haven't had a new router since then that, and we provide routers for our customers, then that's a good indication that, wow, that's a really old router and we should come out there and give you a new router so that you have better service from us. And I find that is one way to keep people by actually reaching out to them ahead of time before they actually cancel and go to another provider.
Great. Thanks, Kerry. Thanks, Martha. Maybe kind of one last closing. It's really a quick one, hopefully a fun one. For each of you, what do you prefer? Numbers, graphs? Some people prefer numbers, some people graphs. Maybe a combination. So for each one of you, maybe what do you prefer and why?
I'll start. I
like numbers because I'm an accountant.
So I much prefer graphs. What we've noticed is as we get bigger, and this is just kind of anecdotal, is when we first started, if we had 100 people that were delinquent, we would just panic. That was awful. And we would all start calling and trying to collect the money. And so as we grow, especially in times of high growth, that 100 customer number kind of stuck in our heads. So even though we had 5,000 customers and 100 people who were delinquent, it gave us kind of the same amount of anxiety when we had 5,000 subs as when we had 500 subs. So when we've noticed is that when you pick a specific number, you're missing out on the bigger picture. And it's hard for me because I am an accountant. I get fixated on that one number and say, I don't want it to be 100, I want it to be 99. But what I needed to look at is more what are the trends and what are the percentages as we grow, because you can't, I at least cannot rely on my memory to know, oh, okay, well, we grew 4%. So now, that delinquent number ought to be 104. So it's important to me to have graphs so that it highlights those things and I don't get, this fixation on something I shouldn't be fixated on.
Good, thanks, Kerry. Ross?
I'll jump in lastly, it's going between charts and numbers. I'm getting a little feedback, but too many years in auditing makes me really love looking at numbers. I'm trying to change myself, doing more graphs and more, it's easier to look at trending that way, looking at more of the 24-month, 36-month stuff. Other than when you're an auditor, you look at 12 months. That's what you're kind of stuck with. So I like both. I still like numbers a lot, but graphs are still pretty.
Well, good. Thanks very much. I think the takeaway for me from that is that, we're all different, and each of us, some of us prefer numbers, some of us prefer graphs. And, I think the important thing is to, at the end of the day, being able to provide the user of that data in the best format that they're going to equip them, enable them to make the best decision for the company possible. So with that, I just want to thank everyone for being with us today. Thank the presenters again, Rob, Martha, and Kerry. Really appreciate it. Thanks for sharing some insights for all of us today, and we hope you've been able to take away something valuable from this presentation. And just with everything that's happening around the world with this COVID virus, we just want to encourage you to be safe, to look after yourselves, your family, and your business. And it's challenging and trying times for all of us. But I know that humankind is resilient, and we're going to come up with solutions. And so hang in there. We thank you for being with us today and appreciate you. Thanks, and take care.
Thank you.